Dividend investors, bonjour. This is Mike Yehu, founder of Dividend Stocks Rocks and passionate investor. Today, Dividend Uncut report is all about should we pick falling knives or premium stocks. I've received lots of questions from my members and readers at the Dividend Guy blog asking, Mike, everything is on sale right now. It's amazing, but how can I make sure that I pick the right company? Should I go for those who lost 40, 50, 60% of their value, offering yield like crazy, like 8, 9, 10%, thinking of the ExxonMobil, for example? Or should I go to more what we usually say, overpriced stocks like Microsoft or Visa that haven't lost that much? And that's a very interesting question. And the first answer is it depends on where you are right now with your investment strategy and how much you can afford to lose or not. Obviously, when you catch a falling knife, we don't call it a falling knife for nothing, right? If you're trying to catch a falling knife and you miss it, well, chances are you're gonna end up having a hand cut, and then you're gonna bleed, right? This is the problem. When you go into falling knives, it's a case-by-case scenario. You have to go deep down and analyze the company to make sure that there's a false reason why the company is going down. Right now, the thing is, we have a limited amount of data on the outcome, on the economic outcome of the virus outbreak. So we know the virus is there, we know how to take care of it, but the problem is we don't know for how long we have to apply social distancing. We don't know for how long consumers are going to hold on to their extra dollars to spend. And obviously, we don't know if we're going to have lots of bankruptcies or an incredible amount of bankruptcies. Based on that, I'd say that personally, I would go for premium stocks, like those that have been proven to be worthy of your portfolio for years, long dividend growth payers, obviously, and the thing here is if you want to play with falling knives, maybe you can do it with like what I would call play money. So maybe 5 or 10% of your portfolio. And then the trick that I would use is to target a specific sector. So let's take a look at banks, for example. I made a video on banks yesterday. If you look at Canadian banks, most of them drop around 20-25%. However, you have BMO and you also have National Bank that had been that have been hurt a lot more. We're talking about probably like 40% down. Then you have to look at what's the difference between BMO and TD, for example. And then you can make the differences and understand if there's a real risk here or the market is just being crazy and BMO and National Bank are the two smallest bank among the big six. So that's probably why. I mean, most people will target their money towards Royal Bank or TD Bank because they're the largest, they're more established. They might want to go with Scotiabank because it's international, and then less exposure to specific country. On the other side, do you really think that there's something wrong, like 20% more wrong with BMO and National Bank? Well, maybe not. And this is where you can catch great opportunities. One of my company right now in my portfolio, CAE, has been being like killed on the market. This one, I would like to take a look at it and see what's happening, what's the outcome in the next 6 months, 12 months. And if I can find something interesting there and say, oh, you know what, the company has enough liquidity, they're generating cash flow, they have contracts over there, so yes, next year will be rough, but it's not the end of the world, well, then it's time to deploy your money. And finally, keep in mind that while everything looks on sale, it's not really the case. If you look at many great companies, they're just trading at their 2018 bottom level. Remember, I know it's only 2 years, but some people tend to forget that in 2018, the market dropped by almost 20% from its peak level. So if you look at the price around December 2018, there's a lot of companies that are trading at that level. So you just lost like 2 years. So it's not necessarily an incredible, great deal that you're having right now. It's just another opportunity to buy companies that used to trade at a lower price, but it's not the end of the world. So to end this video, I would definitely go for more with premium stocks, dividend safety first. And on Friday, I will be issuing a large newsletter to my DSR members about all the stocks that I like for each sector. This should help them to trade and to focus on great premium stocks. I would probably avoid hotels, airplanes, and energy stocks at this time because it's highly volatile. Yes, you can make a lot of money, but there's a lot of companies there that will not make it. There's a reason why the stock crumbled, and it's because their business model is flawed and they will not go back up. So don't think that anything that you're gonna buy now is going to go back to January 2020 price. It's not the way it works. So if a stock used to trade at 50 bucks and it's not 20, maybe there's a good reason, and maybe it's gonna stay at 20 for a long time, and maybe it's never going to go back up to 50 bucks. Tomorrow, we're talking about how to deploy money. There's a lot of people, they're just like, hey, I've been sitting on cash for so long, or I just sold a property or whatever. I have like 100K, 200K, I have a large amount to invest on the stock market. Should I do it now? Should I do it completely now, or with stages? And how can I actually deploy that money and make money out of it? Because yes, this is a great opportunity if you know how to handle it. So tomorrow we'll talk about that. And until then, stay invested.